Due to the economic volatility and the credit crisis, we have not changed our strategy in terms of how we view REIT performance. We continue to look for companies that can deliver good risk-adjusted returns and companies that can create shareholder value over the long term. What we find most attractive in this environment right now is that companies took this opportunity to de-lever their balance sheets. They termed out their debt maturities and diversified their debt maturity structure. They've readjusted their mix of fixed and floating rate debt. And so from a capital markets perspective, from a capital structure perspective, they've done the things that mitigate risk and also put them in position to maintain flexibility to grow. If we look at opportunities going forward, we like companies that have the opportunity to lease up properties right now, as well as generate rent growth. We're also finding opportunities in companies that can grow internally and that have the balance sheet capabilities to grow externally through acquisitions or development in the case of multifamily. What we're worried about a little bit in this environment is that given where cap rates are, we're a little bit worried about how much companies are giving credit to the pro forma in the underwriting process, and are their exit cap rates too aggressive in this environment. I would say going back a year ago and looking at the economy and looking at it today, that we are a little bit more optimistic on fundamentals going forward. Number one, I think it's more clear that we've turned the corner economically. There is jobs growth. It's a question of, is it 50,000 jobs per month or is it 200,000 jobs per month? And I think if you look at real estate in general, if we are somewhere in between that, 100,000 jobs a month, that's a pretty good environment because no supply has really been added in commercial real estate. We're at historically low supply additions. And if we can grow at 100,000 jobs per month, that would generate enough demand to get lease-up opportunities and occupancy gains, but it wouldn't be too strong where interest rates would go up, so that would be a good environment for commercial real estate. I think the other positive over versus 12 months ago is what's gone on in the capital markets. Number one, we have a CMBS market beginning to come back right now. Number two, the secured and unsecured debt markets have come back for real estate. So we're seeing insurance companies lending again. We're seeing the unsecured debt market come back in a big way. And then from an equity perspective, if you look at the core real estate funds, we're actually seeing investment queues into those funds again, so waiting lists for people to get invested into core real estate funds. So that combined with mutual fund flows into real estate continue to be strong, and their ability of the public companies to raise equity in public offerings. All of those are a lot different from last year, which makes us optimistic about future growth.